I want us to consider how to effectively track and manage dividend reinvestment planned investments for wealth building. How do you track this plan? How do you effectively manage this investment plan for wealth building? That is the focus of this video. Number one is you set up a dividend reinvestment plan. You set up a dividend reinvestment plan. So in this case, you would enroll in the plan. You enroll in the plan. So most companies offer dividend reinvestment plans, which allows investors to enroll, directly through their shareholder service or brokerage account. It could be done in conjunction with your broker. Your broker could help you to enroll in the plan. So some companies even allow direct enrollment for those who purchase shares directly from the company, depending on how you bought your shares. If you bought it directly from the company, you could enroll directly. If you bought it through a broker, then your broker would facilitate the enrollment process. You have automatic reinvestments. Another procedure here is automatic investments. So once you enroll, the dividends are automatically reinvested to purchase additional shares, often without commission and transaction fees. And this ensures that your plan is set to reinvest dividends as invest dividends as you prefer, according to your preference. Number two is monitor dividend payments. Monitor dividend payments, and this will include tracking dividend dates. You track, company's dividend dates. So keep track of the dividend declaration and payment dates for the companies you are invested in, the companies that runs this particular plan. These dates will then determine when your dividends will be paid, and when you could reinvest those dividends. You also consider dividends amount. Dividend amount. You review the amount of dividend paid out regularly. This amount may increase over time. If the company raises its dividends, that will provide more capital for you to reinvest. The more the company raises dividends, the more the disposable income you will have to reinvest, in accordance to this plan. Number three is review dividend reinvestment plan statements. You review the statements related to this plan. So you consider regular statements. Most dividend reinvestment plans provide regular statements showing the number of shares purchased during the reinvestments, along with the dividend reinvested. To show you the number of shares purchased as well as the dividend you reinvested. These statements can be mailed to you online. You could receive it through your email, and you also take cognizance of you monitor growth. Apart from reviewing the statement regularly, you also monitor growth. You track the total number of shares you own and how the reinvestment is affecting your overall position or your overall portfolio. So reviewing your statements will help you assess your investment progress and the compounding growth taking place in the portfolio or in that specific stock. Number four is you track total investment value. You track and determine your total investment value. This will require you, you have a portfolio tracking tools. Portfolio tracking tools. You use portfolio management tools or apps to monitor your overall investment portfolios, including your dividend reinvestment plans, and the shares you bought through this particular plan. And these tools can automatically track the market value of your dividend reinvestment plan based on the current stock price. If you make use of this tool, they show you precisely the overall value of the portfolio. It makes things somewhat easy for you. You don't need to calculate it if you're calculating manually. It just show you precisely. The your the value of your portfolio at the prevailing market price. So you also track cost basis, tracking cost basis. You keep a record of the total cost of acquiring shares, including the reinvested dividends. This helps you track your cost basis for tax reporting, for tax purposes, and also to understand your total investment in the company. You track what has been invested, and you also determine the current value of your investment. It's meant for tax purpose and also to be able to give you an idea of the yield you have been able to obtain so far in your portfolio. Number 5 is rebalance your portfolio. Rebalancing is crucial when it comes to achieving your long-term objective as an investor. So there's this regular portfolio review you need to undertake. While dividend reinvestment plans are a long-term strategy, it's essential to periodically review your overall portfolio to ensure it remains diversified. Make sure it remains in line with your overall investment objectives. And so dividend reinvestment plans, is a single stock. In a single stock could overexpose you to a particular sector or a company. So you don't just get yourself concentrated in a single sector or in a single portfolio, or in a single stock. You try to diversify as much as possible. So you adjust your plan enrollment, adjust your dividend reinvestment plan enrollment. If your portfolio becomes too concentrated in one company or sector due to reinvestment, you consider adjusting, your plan settings, or diverting some dividends to other sectors or to other investments. As you keep on reinvesting your dividend, you may end up getting over concentrated in a particular stock or in a particular sector. In that case, the need for diversification becomes very important. You need to diversify so you can get a dividend and invest in other sectors and in other stocks. Not necessarily the one you've investing in, you've gotten the dividend from. You can invest in other related. Please subscribe to this channel and like this video, and also make a comment in the comment section where necessary. Number 6 is you monitor performance metrics. Monitor performance metrics. So when it comes to monitoring performance, you need to consider dividend yield and growth. Dividend yield and growth. So keep an eye on the dividend yield and its growth over time. A growing dividend is a positive sign of company's financial health and long-term stability. So supporting continued reinvestment. In the case where the company, is growing a dividend, it's a sign that the company is doing well financially. So you may keep on reinvesting in that company. But if it doesn't show a sign of dividend growth, you may consider selling your position or using your dividend elsewhere. Use your dividend in another investment. So you're also looking to stock price performance, the performance of stock prices. So these there's this particular idea to do with tracking the performance of the stock itself. As the share price appreciates, will increase the value of your dividend reinvestment plan investments. So reinvested dividends, buy more shares and stock price grew, and stock price growth will certainly increase the total value of your position. As the stock price is growing, the dividend is equally growing. By the time you combine the two, you discover that you have a net growth that is quite attractive. Number 7 is tax consideration. Tax consideration. So you also need to uh, consider capital gains. If you sell shares acquired through dividend reinvestment plan, you may have to report capital gains or losses based on the difference between the selling price and the cost price basis of the shares. You bought at this price, you sell at this price. If there's a gain over time, it will attract dividends, it will attract capital gain tax. And if it's a loss, that would attract kind of loss harvesting. So you maintain accurate records to facilitate tax reporting. Although this could be done automatically, your broker can help you to settle relevant taxes. I don't know how it happened, but in my own country, I think everything is done at the brokerage level. You don't need to pay tax individually when you have the proceeds of your investment. You don't do that. Number 8 is evaluate, dividend reinvestment plan performance. You look at the long-term focus. These plans are most beneficial in the long run, and it may take years or even decades to fully see their wealth building potential. It's not for the short term. So evaluate your investment over time to see how reinvestment, compounding, and stock, price growth are contributing to your wealth. So you need to have a long-term perspective. So you adjust your strategy and when necessary. If a company cuts or freezes its dividends, consider reassessing your dividend reinvestment plan participation. Alternatively, even the stock becomes volatile or underperforms, you may want to redirect your dividend elsewhere. You reinvest your dividends in some other stocks. It must not be in that stock, because you do that on a case by case basis. It's based on merit. It's not just automatic. If it does very well, you invest. If it doesn't do very well, you can take your dividends elsewhere.